Okay, well, thank you for joining today. This session will be recorded, and the first session was recorded, but it was not saved. There was an error, but I'm going to go over quickly just the trend profile from Monday, Tuesday, Wednesday, and then look at. Can I even? I don't have it set up here. Well, maybe. Actually, I don't have the trend set up here. So I'm going to set up the trend first together and then walk through this step by step. And then we'll go over the market internals. So not everybody is very familiar with setting up the internals on your computer. And I truly believe that if you understand how to read the market internals, you will become a very good trader, probably better than me. The only reason why I'm not as active as I used to be is because there's a lot of other things that I'm doing at the same time, but that's not an excuse. However, the trend, when I do read the trend, I read it and I understand exactly what the market internals are telling me. The importance of it is that it's out of all the indicators that people are selling, it provides a high amount of reliability. It's correct. Basically, it's correct most of the time in terms of market direction and sentiment. And if you grasp it, then you'll be able to make better trading decisions in terms of, what positions you get into, trading setups, and also position sizing. You may think that position sizing is all based on your ability to find the correct setup, and that's part of it, but you also need to have the market cooperating, right? Very few instances where the market's crashing, there will be a couple of stocks that are doing its own thing. But most of the time, if the market's crashing, then in your long calls, you're probably not going to be coming out of that with a profit. So it is also important to understand how the market internals can be advantageous for you, provide you an edge in knowing that, okay, because I have this set up and the market looks like it's going to move higher tomorrow based on what I read here, then I want to increase my position size to the actual amount that I've designed it for. So we're going to go through that today. And this is the workspace. And then after we set up the workspace, we're going to go through Monday, Tuesday, Wednesday's trend profiles and show you exactly what the internals have been telling us. Okay, so in the, where is my Discord? So in the Discord room, under pinned messages, I've created a link here called Trend Day 1. And if you click on that, it'll take you to the Google Drive. This Google Drive will contain all the information and of today and all other information moving forward. So again, I think the market internals is the edge that you may be looking for. I think without it, I would not have any clue what I'm doing. And I've taught this a lot. I've asked people even to pay for it. And for me now, I don't really need to really ask for money for this. I think it's more important just to share the information and make sure that everybody understands it. Okay. I've charged, I think, $200-300 on this stuff, and I've taught probably more than 1,000 students. And I actually when I go into other trading rooms, I'm kind of wondering why those people don't really talk about the internals. Professional traders must understand the internals. Like I said before, if you go to the trading floor in the New York Stock Exchange and you see the big sign that says TRIN, and you ask people what that means, then they're going to know exactly what kind of trader you are. And you can be someone who's traded 15 years technical analysis with lines and charts, but if you understand how we use the TRIN here, in theory, you can almost not even look at any chart, and you can just look only at the TRIN profile and figure out when to be trading and when not to be trading. So it's almost that good. The only thing that we cannot predict is there's more than 5,000 companies listed in an exchange. We don't know which one is going to make the 5-10% move. Okay, we just know that the market is going to be in a better shape tomorrow, and we can take advantage of the setups that we identify if we model the TRIN correctly. Okay, so here's the PDF. You can download it. It's all available in the pinned section. And I have this workspace here, and what you want to do is pretty much you can detach any workspace in Thinkorswim. I will be making a dedicated server, so I'll be streaming the market internals on a dedicated server. What that means is that all members have access to these streamers. These streamers are actual people's accounts. They have about 60, 100,000, 400,000, $600,000. There's a lot of them. Okay. All these accounts, these are all people's money. There's $6 million here. Okay. And I'm going to create one more under here. That's going to be 104. And then it's going to be called internals. Okay. So these are all streamers. Any one I click on here, for example, it's going to be streaming someone's account. Okay. And if I go into another account, it's going to show the same thing. Like, I don't know. I shouldn't really go into, but anyways, you're going to be accessing the streamer, and then I'm going to be broadcasting those internals for everybody. But if you have Thinkorswim, and if you have more than one monitor, because you're going to have to dedicate one monitor for this, I do, at least one section of your screen, then it's probably a good idea to set this up on your computer. So let's do it together. So I would just basically detach one of these screens and go like that. So you got 4 in a row, 4 on top of each other. And then I guess the top one, I'll call it ticks. Let's see, let's follow the instructions here, what I have here. So we have different market internals. We've got volume, advanced decliner, the ticks. So I'm going to choose the ticks. So because I have experience with all of these, right? I know what this does. I know what this does. But for me, I want to stick with, let's add the ticks first. Trim setup. And when I go through this, it's like going through my instruction set. It's not that clear. Okay. Anyways, so let's put the tick at the top here. Whoa, see the ticks? And I probably want to get rid of all this stuff. That's not going to do anything for me. So that is the ticks. And we'll probably use the 10-minute time frame. So when you read articles or some literature or whatever, textbook that's teaching you how to read this, it's kind of complicated. Let me go into the drive and see if there's any Okay, there it is. So in the drive, there's this text file called ticks. And if you open it up, it's going to give you this. So copy paste that into, so what you want to do is create the top form and then enter tick. And then click on the edit studies, that potion bottle, and then create. And then, so you want to copy this code on the right-hand side into this new script study. So we'll call it, just call it whatever you want, ticks, okay? So I've already added it there, and then you can just copy paste this. So Control C, Control V. That's the meaning of life. Let's see if it does work. Does it work here? You know the meaning of life is Control C, Control V, right? And then once you do that, you click OK. And then it'll be there, right here. So all I did was I went into the pin channel, and then I went to mark internal setup and went through the instructions. And I'm like, oh my God, this is crazy. Roger, what? I think if you go through the video, you'll probably go through step by step what was done here. But I wanted to put the ticks first. So I went to, oh my God, when I go through this, like doesn't even follow. There's no flow. Geez, bad Roger. What was I doing? Okay, anyways, so I called it come ticks. So it's a weird name, but here I call it ticks underscore 2021. You call it whatever you want. And then when you click OK and apply, it doesn't really change anything here, right? So what you need to do is you got to go click on the gearbox and then click on no. And when you click on change the hide come tick, okay, that's not, I'm not speaking Chinese or anything like that. There's no innuendo in there. You click no, and then you click OK, and then apply. And what happens is you should get a different form here. Is it not working? Let's take a look. What do I need to do here? I forgot how to do this. Show price plot under general. I think that's right. Oh, there you go. Okay, so there is some information in that that helped. Okay, so that's the ticks. That's what you want. So what does this describe? Well, I think it's a lot easier to interpret the internals using profiles compared to this stuff here. So when you go through, let's create, there's a 0 line right around here. Okay. That's the 0 line. Whoops. And then, so I'm not going to draw a horizontal line across this whole thing, but each candle there is representing a bunch of buying and selling. Okay, so the green bars that push above 0 indicates the general market is being induced by buying programs. And then it reaches up to close to, well, if you want to know the true max value, all you got to do is go on a daily or monthly, see what it looks like on monthly. Yeah, so here in the past, whatever, 2-3 years, let's go further out. 5 years, let's go 10 years. So here you can see in the past 5 years on these monthly candles, you can see that the ticks trades within a range. 1,855, negative 1,916. So there's a zero line that goes right through these candles, and that's your reference. And anytime the candle moves above the zero, that's a buy. That means there's more buying. And if it goes under zero toward the negative 1,916, that's a sell bias. There's selling going on, which means that once it hits the extreme, that's the max selling. And when it hits the extreme at 1,885, that's extreme buying. It's reached its max. It's not much more that can be bought. And there are limitations to the amount of buying that goes on in the market. So they have these caps, right? It just makes sense. Like if you go to a supermarket and there's 10 apples and you buy all 10, how can anybody be buying more, right? The exchange has limits in place, kind of like a circuit breaker. Once the market crashes like 15%, they'll stop the selling. Okay. Notice that there's circuit breakers when the market's crashing, but when the market is ripping up higher, there's no circuit breakers, because they have those they know that there's a lot of sellers in the market that will maintain prices within a certain range. Now, low float stocks like those meme stocks, they don't have a lot of selling. Mainly, they're all manipulated because of the low float. So those are not often regulated, and they do have a tendency to get pumped artificially, which makes it a great opportunity for pumps and dumps. Okay. But for larger companies that are in the billions and trillions, it's not likely to see the percentage move up like 15% and have the exchange halted. Okay. All right, so that's the ticks, and I've pretty much showed you how I came up with the min and the max, but that's not really relevant. So let's go back to the 10-minute time frame, and you might be asking why 10-minute, because that's that's based on experience. You can use something a little bit lower, and it's very similar to kind of like people using 1-minute charts versus 30-minute charts. Now, these are market internals, and they work very well on intraday, but the data that comes in has a bit of volatility, noise in it. So you need to kind of introduce not 1-minute time frames, but an offset. So 10 minutes is a good enough number. 30 minutes is too much. 10 to 15 is what I find works the best for me. So put it onto 10 minutes and then go ahead and to the gearbox and then make sure that the show subprice graph is off. And then now you have a whole different interpretation of the ticks, the buying and the selling. Okay. Now what this represents here is you can almost think of these red dots as TTM squeezes. Okay. But these red dots imply that there is a sell program in the market. So there's going to be a bias that more selling is going to be coming into the market. You can put, if you like to have a little bit more information, okay, having more information is not bad, but you can put these on top of each other like this. And let me see if I can align it a little bit better than this. So this is 10-minute on the 5-day. So let's change it to 2 days. I think we need 5. And then this is the 5-day. And I just have to align it. So this one has to be pushed out. Ten bars to the right. Maybe 25. Let's see what this one's set to. 32, 10, 10. 10, 10. Okay, so now they're all aligned, right? Okay, now you have 100% transparency. The resolution is to the next level here. Look at all that detail. So look at that right there. So 1,419, and we're still in this cell profile, which is all in the red cloud. Okay, so in the past, since last week into Monday, we've seen just persistent selling. Persistent meaning that profile is same color and it's continuing to move, continuing to grow with respect to time. Okay, so it's persistent. So that's the profile showing selling has been there were more sellers than buyers, and kind of saw that coming in last week. And the red dots here indicate the red marker, the outline of that, meaning there's aggressive selling. And the green one here is just buying. So green dots. And yeah, same thing over and over again. I don't know, the other line there is just the it's just the moving average. Okay, so you can add the ticks here, and if you're really interested in the ticks and it's in understanding the behavior, you can model both of them side by on top of each other, getting you clear resolution both on the profile and also on the raw data. Raw data is very hard to interpret. So if you do go take some courses and you see other people talking about it, showing these high extreme values, keep in mind they have a lot more experience in terms of they were just kind of introduced to this approach from the very beginning. Kind of like, I don't know, just an old school way of when before technology was advanced, or they just didn't have a good idea of profiling the data like I do. So I profile a lot of my raw data when I do earthquake studies and I do ground interpretations. And one of the hardest things is kind of, modeling the ground conditions where there's a sand layer and how thick it is, and then how thick is the clay layer. And then when you get a silt to clay layer, how do you differentiate that? You won't be able to do that differentiation using this data. Like, how would you, if there's three types of material that you're working with between Monday and Tuesday, throughout the whole entire week, how would you be able to, other than knowing the extremes, the high and the low, how would you be able to interpret the in-between layer, the material that looks the most similar at eyes at first glance, right? So, I mean, just some going off topic here, clay and silt is very, very difficult to distinguish from eyesight. And when you're poking a probe in the ground, it's not very clear sometimes, especially in some parts of the world. Some clays have high plasticity. Silt, it may look like it has apparent plasticity or cohesion, but when you bring it to the lab, they act totally different. So in order to model the ground, that's what the clients ask. They want us to interpret the ground conditions. We need to be able to, with a high degree of confidence or certainty, we got a good idea of what's underneath surface. So you can see here from the ticks, you can't really get that type of feel, like what kind of material are you working with, like in between, like here. We kind of know what's 1,000 when this bubble pops here above 1,419 and negative 1,153. So let's create thresholds plus or minus 800, right? So whenever the ticks goes up plus 800 or negative 800, we kind of have an idea what's going on with the market. But in between, that could be that ground layer where it's like, is this silt? Is this clay? Is it silty clay or clay silt? What is it? and that's the hard part. So when you profile it using this indicator, then you can visually see what all of these things represent on a time dependent in the transient fashion. Okay, because these are all transient in nature. And not only that, we can accumulate the ticks to show the actual profile, so we can get an idea of what kind of conditions we're working with. So here throughout the whole entire week, pretty much, the profile has been a little bit more on the selling side than the buy side. Okay, and then look what happened today. It just power hour rally came in Wednesday, and then it just from the very beginning, actually we called that right there at around 9:40, which is almost the same time that I typed in right here. Trend showing a slight bias to power hour rally at 7:21 a.m., which is Pacific time. That would be 10:21 a.m. Eastern time. Okay, so the next part here is you want to put in the next one is called the trend. All right, and this is that's the trend. So it's kind of like the raw data, and you can see that it has. We talked about this in the previous session. If you model it on a monthly, you can see it only goes between 0 and 15.25. 15.25 is like rarely ever happens. Maybe once, like it would be like an earthquake of a magnitude of 10. It doesn't happen very often, but you can, if we remove that outlier and then just model the average max, then we can say that the number of candlesticks that hits this horizontal line, the most of them hit them at around 3. Okay, so we can just say 3. And then the low is obviously 0, but 0 is a bit too, I mean, that doesn't happen very often. So we want to create a threshold and say where all those candlesticks reach the low there. It's around 0.5, maybe 0.4. Okay, so now you know how the min and the max of an internal, okay, and the reason why we can describe a min and a max in this internal is because we went through the formula, and that formula in the numerator right here, the advanced declining stocks at the top there versus the volume. The volume is too big, so you can't really measure that with a. I mean, you can measure it, but it's quite random, right? The only thing that's not random is the number of stocks that are moving, because there's obviously not, like listed in exchange, there's obviously not a million companies listed in the market, right? I think it's about, for my best guess, I think it's about 3,400. Okay, so that's the nice thing about the internals. It has a fixed number in there, and keep in mind the data set we're using here, the raw data, they work with the same data as other market internals. So you might get into a problem where you're double dipping. Okay, so I think the ticks and the trend and a little bit of the VIX futures with some volume. So there's the advanced declining. These are enough for traders to kind of get a real feel for the entire market. But I think the ticks and the trend and the VIX is good enough for the basics. And if you want to add the advanced declining ones, you can go ahead and add them there. Okay, so now with this trend formula, I want to change the set so that it's represented as a 10-minute time frame. Okay, and then now you can see and then maybe have the alignment change so that it's matching the data set above it. So expansion area bar 10 bars to the right. And now they're all kind of lined up here, right? So there's a little bit of a space. And then for the VIX, we just use the daily or whatever you want, 70-minute. And we don't need to know the historical performance of the VIX. We just need to know because the VIX measures just the fear of that day. So we don't care about what the fear looked like 10 days ago. So I'll just change the time frame from, I'll use the 70-minute and then maybe have it model just 2 days. Is that good enough? Maybe we use it daily. It doesn't really matter how you use the VIX. You just need to know if risk is on or off. And here you can see there's a gap. So that's a 20.51. And that's what I mentioned here in the morning. I think, actually, I probably didn't mention it. Yeah, right here. Based on the structure on the futures, there's a 52-week high attempt either tomorrow or the TGI cycle, which has started today. Okay, so the information that I'm reading from the internals and the fear, it's all being shown. It was, first of all, documented in the trade alerts to give information to everybody about what is being read from the internals. But now I'm showing you exactly what I'm seeing here. So now you have a better understanding and appreciation for the information, the raw data that's coming from the market internals. Okay, so now we're going back to the trend. What you want to do is you want to create these horizontal lines. So you right click and then you go add drawing, and then you can add this horizontal price level. And then I think you want to have it extend to the left and right. Maybe use like so high trend value is probably going to be set to green. Let's give it a little bit of thickness. All right, so now you can see there's a value, a threshold level of what, 2.11. Let's make it around 1.5. Okay, because that's kind of like the average between the max from 3 to 0, right? And then the 0 line here is represented in the white periphery line. And then I think we mentioned that the trend value at around 0.4 would be the low, but we've seen 0 before, but that was when the Fed was in the market. Last year, when the coronavirus hit, the trend was hitting 0 every time. So it was crazy. They were just buying everything. Something was gobbling up every sell order. No matter how many times people were selling to short the market, they kept them buying it more. It was 0, 0, 0 across the board, which is impossible. So let's make that red, give it a little bit of thickness and extend it out to, so 0.4, I guess 0.8 would be the halfway mark between, well, is it? No, it's 0.4. Yeah, I think it's 0.8. All right. So now you have these ranges that are being modeled for you to kind of give you where the trend hits intraday. The next part is now we're introducing the profile, right? And I keep on talking about profiles, and that's because when you're given a whole bunch of raw data, you have to interpret the data. And the best way to, from my experience, actually probably with any other experience in anything you do, you have to model it, that raw data. And the best way to model it is using a profile. So we have this indicator called the bands, which we use for, oops. And I'll just paste it here in the main chat room. But it's basically the displacement between the 6 and the 21. And I'll create this, I'll add that in there. And then you'll do it, add there. So it's supposed to be in there. Where'd it go? It's like some weird stuff happened. Let's add it here. Okay, oh, there it is. All right, so now you have the profiles forming. Now, the problem with this current formula is that the bands are too tight, meaning that it's like a micromanaging. Have you ever had a boss that micromanages you? It's not very productive, right? We want nice, clear profiling of what's going on in the day. So what you do is you double click into the customizing part and then change the EMA length. Doesn't matter. So somebody asked me what's the difference between EMA and simple. So the difference is one is discretized, where the resolution is lower. Okay, and the other one is higher, exponential. It's like goes into like there's how many decimal places behind that. Simple means that it's just a straight up integer. Okay, exponential is like a lot of floating points, a lot of decimal points, precision. So if you're really, really precise in your calculations, you want to use EMA. But precision does not work in the markets, as you may be aware of. It's all about probabilities. So even taking profits is like you can't precisely take profits at the target that you wish for. You have to do something, you have to approach it a little bit different in terms of risk. So anyways, EMA is more used in like algorithmic trading or whatever, but it's all the same thing. Okay, similar, but not exactly the same. And let's go ahead and change the EMA length to 200. So if I do that, what's going to happen is it'll keep the micromanager 6 tight against the price action, but have the 200 day there, the 200 length overseeing everything, just kind of giving things in perspective of the past 200 candles. So apply that, and then now you can see the profile. Okay. So then when you see that profile, it's a bit clearer, right? Now you can kind of, if you're more of a visual type of person, now you can actually not pay attention to the candlesticks anymore. You can actually understand what the profile is telling you. Okay, those Japanese candlesticks are, one of the worst things. That actually they're clever because they can trick you thinking it's going to go in the opposite direction, right? But if you move that candlestick behavior and profile the patterns, then you can see this red to yellow. And if you take a look at my presentation, that profile here is represented on the right-hand side as like a sine wave, right? Or a cos wave, whatever, it's the same thing. Same thing, different. Okay, so now you're getting to see, I mean, my teaching approach could sound is probably not very structured, right? And this is random and it's free. Okay, I didn't spend too much time. I've been doing this for so long that I know exactly how to get the point across and the information to you so you understand exactly what I'm talking about. And that's what I'm showing you right here. So that market internal day one theory, see how that yellow thing just goes up and down like this? It's a theoretical interpretation of what the raw data is showing you. Okay, theoretical. This is what I want. I want to see this yin and yang, up and down type of the peak and the trough type of profile, which you cannot see when you have this data there, the raw data. So you have to not manipulate it, but you have to take that raw data, model it using some sort of formula, something like normalizing, and then figure out what those numbers means to whoever, right? So I've taken the data and I've modeled it using this sinusoidal wave, and I called it, it's right here. Do you see that? So now you know the trend has thresholds that we've looked at past 5 years, 10 years, 0 to what, 15. 15 is obviously an outlier, so throw that out. Then you go into the nitty gritty stuff to see what your min and max is. So min and max is obviously, we saw 3 and then 0.4, and then take the average between 0 to 3, 0 to 0.4, and then create those threshold levels here where it's green, red, and white. White is representing the 0 line, which is the reference line. 1, sorry, 1. It's that, be careful there. What I said here was wrong. It's a 1, okay? 1 is the threshold level. 0 to 15.25 were the min and max ever recorded in the trend. And then when we do a quick and dirty analysis, just draw a quick and dirty line through all 5 years of data where the most number of candles hit the max and min to derive the max and min. Then we came up with 3 and 0.4. And then modeling that here is 3, we use 1.5. So that would be the threshold for it to move above. That's the 1.5 is the level that is in between 0 and 3, halfway. And then 0 and 0.4, we pick 0.8. Okay, so, and this is basically, this thing right here is basically what I have on one screen at home. Okay. I don't know if this is really going to be, useful. So you can have it there. Maybe have it like that. I don't know how much this is going to be useful. I don't use this, but I'm just showing you the difference between that and this. There is some information that kind of gives you some ideas of what is happening here. So, here the ticks hit an extreme buying level, but it didn't really push the profile above the 0 line. See, there's a 0 line right here. All we see here is a red profile. That's because there's continuous selling pressure throughout the whole entire week. And now we've got buyers coming in here. But when the market picks up, which I think is going to start pretty soon, the profiles actually, I don't think you can see it here because I only have 5-day referenced. Let me see if I can go further. Well, you can see a little bit right here in the preview. Oops. you can see the profile right there in the top left. It actually goes up above zero and creates a yellow cloud. Okay, and that's very good. We're back in the bulls are in charge. So bears are in charge when it's red. Bulls are in charge when there is when it's yellow. And right now the selling was so persistent, it hit a low and it bounced. Okay, so when we look at the futures, man, futures are rocking up at 52-week highs. So it's hard to say that the market's crashing, right? I don't think anyone should be even using the word crash until we're under the 21-day moving average, which we were, but we were holding that support. But yeah, the futures are still poised to make a new 52-week high. And we had the VIX create a gap here, artificial gap. Okay, contracts have rolled over and they've let that gap open, meaning that there's going to be a new 52-week high when this VIX kind of pulls back and fills that gap. All right, so now you want to have this set up on your computer, okay? And you can add other market internals like what do I have here? The advanced decliner and the volume spread. And you basically you use the same bands that I use for the trend, the 6 and the 200 for the volume spread and the advanced decliner. So let me just do that quickly here. So if I want to do that, oops, holy cow, here, and I want to get an idea of the volume, advanced volume. Okay, you can see this is the volume, and I've have these levels here, and then I introduce the bands. See, the bands don't really show you, just shows you the trend. But let's add 200. And then now you can clearly see the trend is a little bit more distinct, right? These advanced declining values here, where I have a red, so if I double click on this thing right here, it's set to 1,448. And you might be asking, what the hell is that? That's the number of companies that were moving up in this range on that day. So back here, when it hit a high of 1,849, the number of companies that were up was 1,849 on the uptick, okay? And then yesterday, there was 1,540 companies that were in the negative, okay? So that just tells you that's how many companies are listed in exchange. So if there's negative 1,540 and positive 1,849, just double that. So there's probably around 3,000 to 4,000 companies, close to 4,000 companies listed in the market. These are fixed. Nobody knows exactly the number of companies unless you work on the floor. Okay, so that comes down to this. Back to the introduction that we had yesterday. When you create if you're serious about trading, you've got to have this on your computer. Otherwise, you're just going to be taking alerts, bending over, tying your shoes at the hip, right? You bend over at the hip, tie your shoes. And that's not good. If you're going to take this seriously, right? Because the only thing that we only known unknown that I am aware of when you're running a trading alert service is that we don't know your net liquid. So we can't calculate that for you. I've given the calculations to you so that you can use for yourself. But if we don't know that, then you're just haphazardly taking uncalculated risk when you're given pretty much 40% probability of success with profit factors of like 2.5, 3, 4, sometimes 10. And that's borderline gambling, right? Anything that gives you a probability of success of under 50% is gambling. Anything higher, it's not gambling. It's kind of what it's called, trading, I guess they call it. I don't know. But you need to measure or understand how to determine your position sizing. And one way to do that with a degree of confidence is using these profiles. So now when we go back and talk about what has happened in the markets, you see this was Monday. And I don't recall, so Thursday and Friday was super choppy. See how the profiles are just chopping along that level 1, that reference there. So when I think about this in real life, maybe when I'm in the on site, asking the drill operators, like, what the hell's going on with the ground? Why is the rig, why is the rig being pushed up into the air? If you don't understand what I mean, is that sometimes we push the probe into the ground so hard that the actual truck lifts up off its wheels. It's being lifted because the ground is so hard. And that might be because there's like a big rock there, bedrock. Now, in some parts of the ground, we won't be able to know because the ground is garbage. So we get choppy zones like this. That's going to chop your account up if you're trading actively. So this is what I call 10 seconds into the close, especially when it hits a trend value above 1.5 in the morning. Now, granted, like if the market is, when you get a 2.03 and you get this profile, and we talked about the yin and yang, right? Where you get 2, and then if it drops below 1 or develops a red profile, you get a bit of a power hour rally type of trading environment. So 2 and then drops. But see, this profile, once it hit 2 and it dropped, it got chopped up. It didn't form a profile like it did today. So today, what I said here is I said, okay, I said here, the trend is showing a slight bias to power hour rallies. And then that's because that profile here is showing a persistent profile compared to this chop. There was a persistent profile here back on Monday, but here on Wednesday, it's obviously it's night and day in terms of the profiling. One is more clear than the other. And then especially when you compare Thursday and Friday, it's pure chop. Okay, and then now with, so now we know what a trend of 2 should look like, where your position sizing should be at the design target, typically 10 seconds into the close. You get this type of profile. Markets are ripping higher in the first 30 to 60 minutes, depending on what part of the day you're in, week you're in, day of the week you're in. And then now, as the market pulls back at the end of the day on a profile like this, so when trend hits 2 and you're developing these profiles, or anytime the trend hits 1.5, just think about end of the day pullback. Because I did the research, the market pulls back a lot in the bull market. That's how bull flags are formed. Bull flags, you get this big ass, excuse my French, you get this big pole that spikes up really hard, long and hard, and then it has to form that flag. And we think the flag is usually horizontal, but actually it comes in different shapes depending on the wind, right? So if the wind is not there, then it's going to droop down a little bit. That's the end of the day pullback. It's a bull flag. Okay. And when you get a trend profile like this, that's yellow, markets get excited during the first 30 to 60 minutes, and that's the bull flag. But what happens at the end of the day? Well, depending on which company you're trading, if there's news or not news, if there's news, then it'll probably just go and pump higher all through the day. But if there's no news and it's just picking up and trending higher because for whatever reason, institutions have more interest in it, or there's news being anticipated, forming a larger bull flag, then it's going to pull back at the end of the day. But that 2.03 here gives you the clue that your position sizing should be the highest at the end of the day, going into the next day. And then as it drops, you've got to make sure that it drops down and forms a persistent profile of less than 0.8. If it doesn't and it chops like this, you're screwed. Well, you're not screwed. You just have to manage your risk, right? You'll know in the pre-market most of the time. So these are choppy. And then these are kind of power hour rallies. And we got the same yellow profile again, where it's gone up above 2. And then we dropped, and the profiles became a bit more persistent, indicating that there's going to be power hour rally at the end of the day, which was the case. Now, when the market crashes, it's when you get 2 trend profiles that are yellow consecutively. And if that happens, yeah, be careful. Don't reduce your position size, and be careful. Look at the VIX, look at all the information, look at which profile, what the profile of the ticks is showing. So the profile of the ticks is in a negative, is showing negative persistent profiling. So we're still kind of in bear territory. But as this indicator starts pushing, as you can see here in the green above the 0 line, it's going to start forming a yellow profile. Then we're in bull market territory. Okay. So when I did this ground site investigation in Calgary for this for fracking, we had to build a dam, a reservoir, and I was the only person that had any idea of the geology in that district. So I went there, and I got flown there in a helicopter, and they gave me a shotgun and some bear spray. And I said, I have no idea how to use a shotgun. And they said, well, you need to know. I said, why? And I said, because you're in bear country. So this is bear country right here, this red stuff. So when you're in bear country, just kind of read the internals together to kind of understanding what you're doing, and just maybe either make a decision on, I mean, if you're bullish, you don't want to be putting such large position sizes when you're in bear market. But as the bear market starts to leave and we're getting closer and closer into the bull market, then yeah, getting these values of the trend hitting 2.0 with persistent profiles, and then seeing the next day drop to a profile that's persistent to the negative 0.8 region, that's going to give you an awesome win moving forward when the bulls are in charge. Right now, you can clearly see the bears are in charge. And with the gap here on the VIX that I mentioned here, based on the structure of the VIX futures, there's a 52-week high attempt coming in either tomorrow or the next TGF cycle. So that's because we recognize that there's a gap there. Okay, so if you have any questions, just raise your hands and let me know. But that's it. That's the workspace. And then on the next session on Sunday, what you want to do is I'll have this streaming on the server. And what you want to do is just kind of make take what you've learned from the past 2 days and just figure out what is going to happen next. So here with the trend profile being negative, being slightly persistent to around the lower end of this threshold level of 1, we can expect some follow through. Okay, coming in tomorrow. Now, if the trend tomorrow spikes up again, hitting a yellow profile, that means the market's going to be choppy again on Thursday after around 10:30 a.m. Eastern time. So it'll do something like this. It gets crazy in the first part and then chops all day long and then maybe pulls back at the end of the day. These are the profiles that you want to be paying attention to. So if I was deaf and I didn't look at any charts, I would only be trading on these days, this and this. Okay. And then when I look at the profiling of the ticks, I'll be like, okay, see how the crosshairs, when I point to this cloud right here, is pointing to this part of the cloud here. That's showing that, bears are slightly in control. And if I go here, bears are still slightly in control. Okay, but you can't really say the bears are in control for the past year. We're just like a couple of percent away from 52-week highs. It's just the short-term outlook has been pretty bearish. This is short-term. This is 5-10 minutes. So in the next hour or two, maybe going into next week or next month, we'll probably be pushing up into the high above zero, into the 10,000, 20,000 region in bull market country, bull market territory. But right now, it looks like we're coming out of it slowly, and we'll see what happens on Thursday. Okay, so my positions going into, so that's what you want. You just want to kind of keep a journal of this and then understand if this makes sense to you. A lot of people who've learned this, they really find it useful. It is useful. Okay, let's see what's the market's doing. So I don't have mRNA. I have Roku. You can see just when I go on the radar, what I do is I just look at the bid and the ask. And so Roku, that's my largest position size now. So I'm back to dating Roku again. It's up 319.85 and the close was at 318.73. So it's almost up $1. That's good, right? Because that means the candle is going to be over the previous day candle. So let's take a look at our beloved Roku. So that's the monthly candle, which looks pretty damn bearish. But if we go into the daily, yeah, so I don't even know where the next level of support is for Roku. It's already past its 200-day moving average. It almost looks like it might get taken out. But we have a wolf wave and we have an ET set up. So we're taking some risk again on this trade. I think we also have a 70-minute wolf wave here, I believe. Okay, it was there. Probably changed. Let's see if I can find it on the on this other chart here. I see one on no, I see one on the 10-minute now. Okay, so that's the best I got here. And it's kind of a broken wolf wave. Not the best, but to me, it looks like it reached bottom. The most important part here is actually the technical aspect of it. So the low here that it made back here in August created a low technically on this MACD right around this level. And then we've dropped down even further by another 10%, but the MACD is up a lot higher. And that is a divergence, meaning there's the indicator is not matching the price action. 1-to-1, because it should, in theory, if the price is moving a lot lower than the previous low, the technical indicator should be even lower. But here it's half as high, it's higher by half, 2 times than the low back here, which was here, what, saying -16, -29. And then here it's at -16. So that doesn't make any sense. And that, because it doesn't make any sense, that provides an opportunity for traders to step in. And because we have a TGIF cycle, tomorrow's TGIT Thursday, we're going to see if this Roku picks up. And if it does, we know that there's a lot of gaps. One gap in particular that I'm actually interested in filling, I'm not going to use Thinkorswim, I'm going to use TradingView tomorrow, is that gap right there at 342. So what time frame is the weekly? I don't think, yeah, I think there is a gap there. Let's go to 30-minute time frame. You know what? I was looking for this gap on Thinkorswim, and it wasn't there. That gap right there. So that is a 7% move that we are expecting tomorrow, or by Friday, or before Tuesday, right? Because TGIT triggers doesn't necessarily mean it's going to make a 7% move, but it could, and that's the gap. I want to catch that gap there. So that's so seeing the after hours for Roku being up an extra buck is pretty cool, because now if we look at the daily time frame for Roku, it's kind of has this reversal candle forming right here. That's not much of a BLT setup. BLTs are a little bit more nasty than that. And now we know that it's going to open above this green candle. That's bullish. That's a reversal. And reversals don't usually look like this. They look like a doji, and then you get the big green candle. So this is the opposite of a reversal right here. This is kind of like a reversal. So we can get something like that. You'll see quite often reversals have a lot of dojis around it. This one was a pretty big one, but that wasn't the bottom. That was the bottom here. Anyways, we'll see what happens. There's a gap there at 342.43. That's a 7% move. I wouldn't be surprised to see the contracts we have go from a buck to $5 to $6. I hope so. Let's see what happens. I think it will. And the gap at 342, right? This market is being highly manipulated. All these pre-market gaps that are forming, it's just crazy. But there's one right there. And if I try to find that on the Thinkorswim platform together, I don't think I can find it. Oh, no, I can. It's right there. Yeah, it's in Thinkorswim, 342. All right, it's good. So we have something to look forward to. We got Roku, we got Tesla. Let's look at Tesla quickly. So Tesla, we talked about it. We have those $800 calls. So for discretionary traders, we have a weekly and the 800, right? And the 800, we closed off at like 223. They pulled back all the way to like a buck, and now they're at like a $1.30. So, and it's not too much of a clench. It's pretty low. But the main thing here is that Tesla looks like it's about to make it run up to that weekly DARVIS, and we said about half, 826. So even though those $800 contracts went to $2 to 160 to literally down to almost 60 cents, I believe. Now it's a $1.30. And if we catch like a 4% move on the next TGIF cycle, right? So from where it is right now, 753, and it moves up by 4%. We'll get close to 788. And then we take a look at the contracts that we have, not the weeklies, but the ones that expire next week at 800, which is right there. And it moves up to 788, which is right here. Then those contracts are going to go up by 1, 2, 3, 4, 5, 6. So from here it goes 1, 2, 3, 4, 5, 6. So it'll be around $5 to $7. Okay, and we didn't do anything, right? We're just kind of holding it. But obviously, when you put in like tens of thousands of dollars on that thing, and it goes from $2 to 96 cents to $1.30, there's a lot of clenching, right? And it's good, Nick. You know, I mean, maybe some people are trading one contract every time, but you know, this is the market, and the price of these contracts move crazy. But if you can hang on long enough, yeah, I guess it could work in your favor most of the time. But if the clench is too much, you might just end up closing it. And that's not what you want to do. So we have a setup here in Tesla that looks like it's going to get up at least to 788 by Monday or Tuesday. We know that Tesla does tend to run up higher every cycle. It didn't do that on last Monday, but it has been doing it in the past 3 weeks, 4 to 5%. So with Tesla being up the way it is right now, right, there's lots of gaps above here, and it could retest the double top here. There's a top here at 784, right? So if it gets up to this top, then our contracts, the $800 contracts, will be worth about $5. If it goes up and does a real double top, then our contracts are going to be worth $98, right? We don't know if that's going to happen, but it could as it runs into earnings. So we do have weeklies of 765. So those things have to be closed before, well, anytime with whatever profit we have. We already closed off one of them with profit, and we're just going to see what happens going into tomorrow, right? We're not going to take unnecessary big risk, especially when we are just kind of in a choppy market, and we'll see what happens there. Okay, and I also have Coinbase. So Coinbase is my second largest position size, and I think the risk and reward looks pretty good. The managing part is straightforward because, well, if it opens below 243, we got to cut it out. But if it opens above it, then it'll start to trend with that A6, and we can catch at least half of the move to 268. And then on the 70-minute time frame, I don't see much of an ideal trade setup, but I do see a gap, and that gap is right here at 267. So that's right about here. How big of a move is that? 7%. So maybe we do get like this big rally in the market and everything's up 7%. Haven't seen one of those days in a long time. They happened a lot during Obama, but these days it has not been that type of market. It seems like it's very slow. All right, thank you very much. There's other positions I do have, but these are the ones that are the most interested to me. We'll see what happens tomorrow. Thank you very much for your time. Have a great evening.